Hello guys, in this video we are going to talk about Greek letters and what are their features and important knowledge, and then let's begin. Here I want to start with naked and covered position, I mean covered options. A naked position occurs when one party sells a call option without owning the underlying asset. If you don't have any underlying asset, this is a naked position. Uh, Reverse meaning is a covered position. I mean, occurs when the party selling a call option owns underlying asset. If you have underlying asset, it's a covered position, guys. Then we have stop loss strategy here. Stop loss strategies with call option are designed to limit the losses associated with short option positions, those taken by call writers, and strategy requires purchasing underlying asset for naked call position when the asset rises above the option strike price, and then the asset is then sold as soon as it goes below the strike price. uh, the objective here is the hold naked position when the option is out the money, and covered position when the option is in the money. This is really basic difference between out the money and in the money. We have delta and dynamic hedging here, and then it is so important, and we have really basic formula here. Delta mean is only change unit and one unit change between call option and underlying asset. What does that mean? Change in the price of an option for a unit change in the price of underlying asset. And we have one basic, I mean easy formula here. Actually, we have two formula here: discrete time and continuous time. Discrete time delta call, we need to have difference price call T1 or T0, and this is spot minus S. This is equal delta call over delta spot. Okay, delta call over delta spot. And we have continuous. This is hard to implying here. Sorry, this is really hard to applying when you are calculating delta, but we have easy formula. Continuous time delta call equal and d1. Okay, and d1. Where is come from and d1? What does that mean? This is cumulative normal distribution, guys. Okay, cumulative normal distributions from ESM. Okay, Black-Scholes marathon formula. And then we need to have here graphical depiction to understanding delta and what is their relationship between in the money and at the money, and what is the curve. I'm gonna try and draw a curve and graphical depiction here. This is sorry. Yes, this is stock price. Stock price. This is payoff, and we have a curve here and here is actually we have more here. This is our delta mean is slope of the period to expiration curve. Okay, this is our delta area and slope of the period to expiration curve. All right, and then um, this curve called payoff. Okay, called payoff curve period expiration guys. And uh we have two different area here. This is really easy to understand. Add the money and in the money area. All right, in the money area, this is our exercise price here. Exercise price. That's mean. Another mean is at the money, guys. All right, at the money. Here is in the money. Here is at the money. We have called payoff curve period expiration, and here is delta slope of the period expiration curve, and this is stock price and delta graphical depiction here. Okay, depiction here. Delta and dynamic hedging is another chapter to understanding better something here. Delta, uh, delta dynamic hedging. For small changes in stock price, this is our symbol. Small changes in stock price. Call delta is n d1 times delta spot. Okay, we'll have normal cumulative distribution formula, and this is the probability. You need to multiply with delta spot and you'll have delta call. All right, delta put is little uh, different, and d1 minus 1 times delta spot, guys. Okay, if you're interested with Black-Scholes Merton formula, you'll understand what does that mean nd1 minus 1 and what does that mean nd1. This is the actual probability occurring occurring in the price in the future. This is really simple. And we have little we have more delta summary here. We have some range from delta 0 to 1, minus 1 to 0. If you have call delta, call delta, it should be 0 to 1 range. Okay, 0 to 1 range. Far out the money delta approach 0. Okay, out the money delta, out the money delta call option approach 0. In the money delta, in the money delta 1. Okay, in the money delta 1 for call delta's range. Put delta have little different, they have negative value here. Put delta range minus 1 to 0. All right, Out the money delta approach again. Out money delta 0. In the money delta -1. Okay, in the money delta -1. What does that mean? What does that mean, guys? Call or put delta always out the money if you have 0. Okay, if you have 0. If you have -1 or I mean negative or +1, you're always in the money. All right, you're always in the money. Put delta, another important thing, put delta equal call delta -1. Okay, put delta equal call delta -1. If you desire, we can have discrete time example delta. For instance, call option goes from $2 to underlining goes 50 to 50.5. What is the option delta here, guys? What is the option delta here? I already given you formula. Delta is 2.2 and 2 over time and over. Okay, we need to have change between different times. I mean t1 or t0, you know, and you'll have some difference here. What does that mean? 0.2 and 3 0 point time, and then it must be equal uh 0.40. All right, 0.40, guys. That is really easy. We have delta continuous time example, right? uh assume that assume that uh ND1 from BSM model for call option on vanilla, or however you wanna call whatever you want. These are vanilla. Call option on vanilla common stock 0.1, and if it's ND1, okay, it's ND1, and if the price of vanilla stock increase uh 0.50 by approximately uh how much will the call price change? Okay, we have ND1 and vanilla stock increased 50 percentage. And what is the delta call in continuous time example? I mean in cumulative normal distribution calculation, right? And this is easy, guys. We have delta call and delta spot. Okay, we talk it here. This is our formula, continuous time example. And what does that mean? Delta call. This is our cumulative normal probability. This is coming from cumulative normal distribution. 0. Uh, 0.8051 times 50 percentage is equal approximately 0.9 or 50. I don't know. So what does that mean? This is delta, guys. This is already our delta. If you change price, you need to multiply it. Okay, you just multiply. No more thing. This you already have delta. This is coming from Black-Scholes-Merton formula. This is our probability. Dynamic hedging. Another chapter is dynamic hedging. Uh, Delta natural hedge, this is important. Delta natural hedge. Combination of long stock and short calls. This is combinations long as and short calls. Okay. Short calls. L is long, S is short. All right. Long calls. So portfolio value doesn't change as stock price changes. Okay. Understand here, please. So portfolio value doesn't change as stock price change. What does that mean? What is our formula? Number of short calls needed, right? This is number of shares hedged hedged over delta call, guys. Delta calls. Okay, this is number of shares hedged. This is delta call. All right. Cumulative or discrete, however you wanna call, however you wanna use. And then uh and then I wanna give you an hint. Delta, if delta smaller 1, always need more calls than shares. All right. If you have delta and it is smaller than 1, always need more calls than shares. All right. Always need more calls than shares. And let's have a dynamic hedging example here. This example is really basic. Don't worry. You have you have 50,000 shares. Assume and D1 is again 851. Um, how many calls need to hedge position, guys? How many need the calls hedge position? This is our formula, all right? This is our formula. I already gave it to you. This is our number of shares over delta call. Number of shares and our delta. All right, our delta. And then this is equal. Okay, I need this. What does that mean? If you want to hedge here, hedge portfolio long 50,000 shares and short 80 option 18.631 position. That's mean is or 186 contracts. Okay, 186 contract short call option. All right, short call option, guys. And then dynamic hedging. Okay, dynamic hedging example. If we have long stock position decrease, long stock position decrease, guys, decrease by again 50,000. Short call increase. Uh, anyway, increase. This is our delta cumulative normal distribution. This is our uh, option contract numbers, and then this is equal times no change portfolio. I mean, uh, if we suppose vanilla stock price falls 1, Here we have long position 50,000 and falls by $1, falls by $1, no change, no change, no change in portfolio. Okay, no change in portfolio because this is dynamic hedging already. All right, this is already dynamic hedging. And but delta falls. If delta falls, delta falls, we need to sell more calls. All right, if delta falls, sell more calls. If stock price falls, no change in portfolio. I want to say that. That's why. So that's why it is dynamic hedging. All right, that's why this is dynamic hedging. We are calling it dynamic hedging. Delta change in calls, but uh, stock price no change any in dynamic hedging portfolio. And then if we have dividend payment here, we have different formula. One underlying asset pay a dividend, and Q is wait. When underlying asset pays dividend, the delta of option forward must be adjusted. Okay, we need adjusted price. If a dividend yield exists, if a dividend exists, delta for a call option equals for a call option equals E Euler. This is the Euler E power QT times and D1. Okay, and D1 cumulative normal distribution, guys. Dividend is a Q. All right, dividend is a Q. If delta for put option equal just little change EQT times and D1 minus 1. Okay, and D1 minus 1. This is same. Okay, this is a put cumulative normal distribution formula. All right, we have futures delta here. Unlike the forward contract, the delta future position is not ordinarily one because of the spot parity relationship. Okay, the delta of future position is, look, this is a delta futures position is ERT on a stock or stock index pay no dividends. All right, on a stock or stock index that pay no dividends. Assets that pay a dividend yield, Q will generate delta equal like uh, always remember, guys, I won't repeat again, dividend is Q. All right, asset that paid dividend yield, Q will generate a delta equal E Q T. All right, this is delta feature, guys. This is a delta feature. If you understand the basic logic, you'll understand everything, guys. This is depend our um, dividend because its stock price dividend price will change and we need to have adjusted price. All right. So formula must be changed. This is dividend equal Q and then delta feature formula here and delta feature formula, change it with adjusted price here. All right. We have portfolio delta. This is funny because every portfolio must be have delta here. The delta portfolio option as single underlying asset can be calculated as weighted average delta of each option position in the portfolio. If we have a portfolio and portfolio delta is delta P equal some operator E equal 1 and weight E delta E, guys. Alright, weight E and delta E, guys. Weight E is portfolio weight each option position. Okay, option position. But weight of option position like a weighted average stocks or weighted average position. And then delta E is delta of option position. Okay, delta of option position. Another chapter is gamma, and then we finish it our delta chapters. I try to tell you features about delta. Maybe you understand. If you don't understand, please watch again, repeat over again. Gamma rate of change in delta. Gamma is really easy. This is change of delta. I mean rate of change in delta. As stock price changes, large when option in the money close to expiration, and small for a deep in the money, deep out the money option does not close the expiration. Use in We should use in out the money option not close the expiration reduce training cost. So we have specific mathematical relationship. Gamma is this is our gamma formula, and gamma as stock where and gamma call and gamma spot equal second partial derivative. Okay, this is already partial derivative formula here. What does that mean? This is change with partial derivative formula, and partial derivative secure call and partial derivative spot secure equals second partial derivative anyway, and this is second partial derivative of the call and stock price respectively. All right, respectively. Another one is gamma natural portfolio. Delta natural position can hedge portfolio against small change in stock price. With gamma can help hedge against relatively large changes in stock price. Therefore, it is not only desirable create delta nature position, but also create that one that is gamma natural. All right, gamma natural. So in that way, neither small or large stock price change is adversely affect the portfolio value. Gamma is important here. So gamma is important here to understand it better delta. Gamma nature portfolio example I can give you. Assume delta has gamma 6000 minus 6000. Also, suppose there exists a traded option with delta is 0.62 and gamma 1.5. All right. Uh, Repeat again. This is has gamma delta natural portfolio minus 600,000, sorry, 1,000, and delta, and then gamma. How many options must be bought or sold to make this portfolio gamma natural? If we desire gamma natural, how many options must be bought or sold? How many options must be bought or sold to maintain both a gamma natural portfolio and delta natural portfolio here? Guys, here. This is easy. We have really basic formula here. Gamma hedge we must buy first of all 4,000 option. Why? Because gamma natural portfolio 60,000 divided by 1 point, this is delta 1.5, this is equal 4,000. And then no portfolio gamma natural but added option have changed delta position from 0 to point 2 point for 80 for 80, and then equal 4,000 our gamma, right? Our delta, sorry, our delta. This is gamma. My bad. This is gamma. For delta 0.62. This means that, what does that mean? This means that 2.48, sorry, 4880 shares of the underlying position will have to be sold, maintain not only gamma natural portfolio but also original delta natural portfolio. This is really easy to understand. This means underlying position will have to be sold, and not only gamma natural portfolio but is also original delta natural portfolio. Another one is, I want to finish it about gamma delta, sorry, gamma Greek here, because we have theta here. Theta measures option sensitivity, decrease time expirations. Theta mean is option sensitivity with time. Okay, only know this. Majority sensitivity with time of option. Also termed time delay. Delta is time delay. All right, delta is uh time decay of the of an option time decay, and varies a function of both and price of underlying asset. Most pronounced when option at in the money expiration, especially in expiration time. All right. Option at the money, especially near expiration time. Okay. Values are usually negative. Theta usually negative. Okay, negatively. Theta usually negatively. Usually increase in absolute value as expiration approaches. All right, know it. Usually increase in absolute values as expiration approaches. And we have theta formula here. This is theta symbol and equal partial call over partial t. All right, this is change call, this is change in time, this is sensitivity. All right, this is sensitivity. Let's have a small graphical depiction about theta. All right, theta uh of stock price theta 0 time x strike. All right, guys, call and put option here and 0.010 and then 0 time until expiration. This is at the money call and put option, guy, call and put option. If we have theta here and this curve continues like that, this is at the money, guys, at the money. Theta is really basic in the Greeks, really easy to understand, measurement times and sensitivity between times and stock price. Okay, stock price. Another one is Vega. Okay, Vega. Vega measures sensitivity of the option price change in the volatility of the underlying stock. All right, underlying stock. For example, it 80 percentage for a indicates that for a 1 percentage increase in volatility, option price will increase 8 percentage. All right. For a given maturity, exercise price at risk-free rate call Vega equal Vega put. All right, know it. All right, no, this is really important. Vega call equal Vega put. When for a given maturity, exercise price, risk-free rate, guys. All right, Vega of call equal Vega of a put. Let's have mathematically specific formula here. Vega equal partial call over partial. Sorry, no delta. No delta. Sigma. All right. Sigma. Partial sigma. Sigma win is volatility. This is partial derivative. I mean change in call price and change in volatility. All right, volatility. Another one is rho. Rho measures measures an option sensitivity to change in the risk-free rate. This is measure of or sensitivity option with and option and risk-free rate. Okay, sensitivity, risk-free rate, and option. Acute option are does not acute option are not as a sensitivity to change in interest rate as they are to change in the other variables. For example, volatility and stock price and the large change in rate have only small effect on acute prices. All right, acute option prices. And we have raw formula: partial call, partial R. All right, partial R. This is a risk free. This is a call price. You also see that all Greeks have same formula, only change here. Only change here, right? Carefully here. And I'll give you some last sample example with continuous free rate and about call option, cumulative normal distribution and delta option price. Uh, Imagine that you have time to mature exploiting. I mean maturity is 3 years. Okay, 3 years. Continuous risk-free rate is 3%. Always your risk-free rate must be continuous risk-free rate. Okay, continuous risk-free rate. Continuous dividends yield is 2%. All right. And D1 equal 70 percentage. What is the delta of option? What is the delta of option? Okay, delta call. All right. We have dividends, we have risk-free rate, we have maturity, and then D1. This is really easy, guys. I already give it you formula. E power minus 2 mean is dividends times T and times and D1 is a 70, guys. All right, 70. I don't know what is answer. What must be equal, what should be. You can calculate it. I just want to give it to this example to understand better me and Greeks leaders. Uh, that's all what I want to say about the Greeks. Next time I'll give you more detailed information about Greeks and option pricing methodology, maybe stochastic process. Thanks for watching me. Keep following, please, guys. Keep following.